Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments, subscribers. I greatly appreciate it. This week up, Wells Fargo. We're going to take a look at this stock, the behemoth in the banking industry. We're going to figure out how much money they make, how much we think it's worth. Ready? Let's get to work. Now, we're going to go through this 2020 annual report from Wells Fargo, filed as of December 31st, 2020. Their annual report. Before we do that, let's review the top three key characteristics that we use to value a bank stock. Number one, top line revenue growth. You got to have it. Number two, earnings growth. We use net income for banks. We need that to be growing. And third, I want to see the price to book ratio at a fair value. Not too cheap, not too expensive, but a fair value to produce an IRR that is economical for us. We judge that for being above market, to beat the market. That's what we're looking for. Okay, let's dive right in. Now, this annual report's got a lot into it. Definitely, please read it. What I'm going to do is I'm going to skip to the P&L because I want to show you something particular. Okay, behind me is the P&L for Wells Fargo. And like we've been doing this series, let's walk through because bank stocks are a little tricky in how they book revenue and cash because their product is cash as well as what we measure for investors is cash. So principally, you can see this here. So interest on their portfolio, interest income right here, $47 billion. That's the interest that they receive on loans that they issue for people. It's your mortgage rate, your auto loan, the interest you pay, that's right here. Their costs are the costs they pay for the cash that they lent you. Now that comes from deposits in your checking and saving account, CDs, cash that basically is held in trust at the bank. Well, they can lend that out, whether the expense is the interest that they pay you. The difference between the two, you get, in this case, net interest income, $37 billion. If I then take $37 billion plus other services, revenues, and fees that they generate, right? So brokerage fees, an example, investment banking fees, credit card fees, mortgage banking fees, non-interest income, $32 billion. I add these numbers up, 39, 32, I get 72. That's total net interest income, net revenue to them. I subtract this number here, $14 billion. That's the provision for credit losses. Basically, they made a loan up there that's showing income, but they don't expect to get the money back on the loan. That's a problem. So I want to hit revenue and write that down. And you can see over time, that was basically $2 billion there, maybe $3 billion here, and then 14. So this massive increase, I'm going to say is a one-time deal as a result of COVID and writing down a bunch of loans that they made. Hopefully that's not systemic and continuing. But revenue itself has been pretty good outside of this one blip being the COVID year. I'm hoping it reversed back. Let's take a look and figure out what they're going to get. All right, the first thing we're going to do when we evaluate Wells Fargo is we're going to take a look at their assets. And we're going to look at the balance sheet, and you're going to see $1.4 trillion to $1.9 trillion, a growth of $500 billion or 4% annually growth rate on the total assets. From there, we're going to subtract goodwill and intangibles, total liabilities, and we're going to subtract the preferred stock, which is all of this material that gives us a book value here. Now, book value is actually what we're buying. When we buy a common stock of a bank, you're buying the book value of the company. And that was $100 billion to $130 billion, basically a 30% increase over this 9-year period of time, which is a 3.3 annualized growth rate in their net book value, which is a solid move for a $1 trillion bank. Book value per share has gone from 18 to 31. Market cap, shares outstanding times price, has gone kind of flat because it's fallen recently as a result of the write-down they had to do. It's also traded recently below book value, below 1 times book value. Historically, though, the bank has had a pretty good run. 1.9% probably high on average, but it's solidly 2 in this range here as people, I think, want earnings to rebound after COVID. It does get a pretty premium. Now, Wells Fargo is known on the street as being a conservative bank. What does that mean? That means that the loans that they underwrite are generally very conservative. As a CFO professionally, this channel is my hobby, right? As a CFO professionally, I run money for corporations. And when we use what's called the treasury service of a bank, that's basically their checking account, their merchant service process, all that stuff. Wells Fargo is the most conservative bank on the street. Like you cannot, not any bank, not any business can simply walk into Wells Fargo and say, hey, I want to set up a checking account and have you manage my treasury services, they are very picky about what companies, only the top quality companies that Wells Fargo will use as customers. I've seen them on multiple occasions turn down business because it's just the business model itself of the customer isn't in the niche that they want. That's just how they run their bank. And I think as a result, you see a little weaker earnings growth because they're not taking anything that walks in the door. They're very particular. And maybe that justifies some of the premium that you're seeing here, almost 2 times book. Maybe people are saying, well, what's there is super quality, so they will charge a little bit of premium for it. I'm not sure. I can't really explain why this bank is over 2 times book value. It's interesting. But it did drop substantially. I mean, look, it went from 2 times to less than 1 in a span of, well, heck, that's 1 year time. That's a huge drop at market value, and might have been a really, really nice buying opportunity at the end of last year, 2020. But if I average, I would expect this to revert north, maybe to 2 times. I got 1.9 here, but if you bought it at the end of last year, I'd expect a nice market multiple expansion on that as the bank normalized, as COVID washes past, and you own this stock for a decade. So that's interesting. Let's take a look at revenue and net income. So revenue for Wells Fargo, let's see, $78 billion, kind of grows up to $685 billion. Nice solid growth track record here. Kind of stumbles a little bit, 18, 19. And then of course you've got the 2020, we've got a $14 billion write down on the loan portfolio. It was 2.6. So that's a really big hit to revenue, and hopefully they can continue to right that ship. I know the CEO has recently cleaned house substantially, letting go a lot of the top executives and kind of retooling management. Also, the federal government is preventing Wells Fargo from doing some of the acquisition, some of the growth work that they want to do because of the fake accounts that they started a backup in 2008. Actually, when they were fined back in 2018, I think. So they've actually capped the number of assets that the bank can hold. The bank needs to make that payment to make restitution to those victims or claimants and move forward. And if they can do that and the cap is lifted on the amount of assets that they can hold, they should revert and continue to grow like the rest of the banks that we've been looking at. I would expect them to be able to grow just commensurate with those guys. But overall, I think the business is moving forward, but for that hiccup. So we're going to have to see how that stacks up in a return. When I look at the shares outstanding, they are buying back shares, much like everybody else. 5.3 billion shares outstanding to 4.1. That is a $1.2 billion share reduction. It's about 25%. It's a really, really big number that they have removed from the share count. So if you bought the shares then and you held them to now, you now own 25% more of the company than when you started with. That's incredible. Having never put a dollar back in the business, that's 3.2% natural reduction in the share count. That's a very good sign. I would expect that to continue. Earnings per share, share price, and a yield. Yield looks really low here because of the weak earnings, but overall 6.7% of a yield. I did exclude these two because it seems a little too out of line. We can actually even exclude this one here because that seems a little out of whack. 7.6% yield. That seems fair to me. This is too low. 9 is too high. I got a 9 in here, but I left it. So it's around 7.6% yield, which is in line with all the other yields we've been seeing as we do this bank series. So I think that's the market yield for bank stock. Let's take a look at our forecast. So forecast here, growing book value by the historical growth rate of 2.6%. Nothing too high. Kind of taken a haircut to it. So I've taken the growth rate that they've had, a haircut at 75%. Excuse me, a haircut at 25%. Just to give a little more conservative forecast, given where they are, the write-downs, I thought it would be prudent to just haircut it just a tad. I'll give you the average book price multiple, 1.9 times book price to book value. And then when I look at the total share price, long-term forecast, I get about a $78 forecast, which is based on the 4.1 billion shares outstanding. If I did the same thing for earnings here, it's tricky. That massive loss that they had here makes it very, very difficult to forecast. So what I'm doing is I'm going to pull in these historic numbers here, about $4 a share. And then what I'm going to do is I'm going to say revenue growth is going to be super, super weak over the next preceding years as they repair the bond portfolio, as they make restitutions to the victims, and the Fed lifts the asset cap that they have, and they begin to grow like the rest of the company is, and that's the rest of the industry is. It's a bit of an assumption. And if I apply the average growth rate of the average yield of 7.6, I get a $60 price target for Wells Fargo. So where does that leave us? Right now, I can buy all the shares I want at $45 a share. I've got two different valuation metrics. I've got a net income yield that's basically $60 a share. And I've got a book value multiple that's telling me it's about $78 a share. Average that $70, $70 a share. All right, I put that into an IRR and I can buy as many shares as I want at $45. I get a company that's yielding a strong amount of net income every single year, which is boosting my return. I can get out at $70 a share out long term, where with a little bit of growth, mild growth, it should return capital appreciation as well as income, which should give me a 14% IRR over the long term. And that is really an above market return. It's 40% above the 10% long-term S&P average. So I think overall, this is reflecting a decent return for an investment on a very conservative bank. Let's review our three key attributes, right? Top line revenue growth, yes, it's growing. Last year it took a hit because of COVID, but it is growing. Net income is growing as well. And book value per share is reasonable. It's reasonable because it's producing an outsized return, a return that's beating the market. So I think overall, we're going to give Wells Fargo a good. I like the sector and I like the bank. I think they've got some hiccups they need to go for. There are certainly some higher growth banks out there, but they come with premiums. This one to me seems like it stumbled a little bit. Its values come down, but underlying there's still a tremendous asset there. If I put this forward into a matrix, 14% IRR at $45 a share. If it goes up in price, I'm out of the stock. I'm not out of stock, but I would not buy any more. If it comes down, I still like the stock even more. So here at this channel, I think you should definitely take a look at Wells Fargo. In fact, most all the bank has been looking really good. So most all the bank sector has been looking really good to us as we review each of these videos. So definitely take a look. If you like this work, you like how I review stocks, check out my website, cashflowinvestingpro.com, where I provide templates to you. I run a course that teaches you how to read 10Ks, how to read a P&L cash flow statement, how to build a forecast model, and how to pick companies that on average have a higher probability of outsized return. That's the trick. Nobody knows the future. What we can do is look at some numbers, make a conservative guess at what we think the future is, and if the probability of hitting that forecast is reasonable, and that forecast yields a return that's above market, that's a good investment in my book. So build a portfolio of say 20, 25, 30 stocks that have a high probability of above average return with limited downside risk, and you have a really good shot at being in the market. Take a look at the course. Let me know what you think. Let me know the comments you like down below. What other stocks you want to see. I'm happy to take requests. Hit the subscribe button and the like button. Throw a comment down below. I greatly appreciate it. Thank you very much for your time. Wells Fargo, we're giving it a good rating. Keep up the good fight. Keep hunting for value. We love this channel, all the cash-hungry, value-focused investors. So thank you very much. This is Rational Investing. Thank you very much. Bye-bye.